For many high-flying markets, rates of return on investment properties have dropped to somewhat low levels. Cap rate compression, lower returns has caused many investors to leave their home markets in search of higher yields elsewhere. One place they may find better returns is by investing in manufactured housing and mobile home parks. My next guest, Ben Schuster, is the head of capital formation for Comfort Capital. They offer investment opportunities in manufactured housing and mobile home parks. Prior to joining Comfort Capital in 2023, Ben spent 7 years on an investment team at BlackRock, the world's largest investment firm. I met Ben at a Christian men's luncheon in San Diego County and since been excited to learn more about the passive investment opportunities Comfort Capital offers, specifically for my clients who are getting out of the very active multifamily apartment building space. And they're certainly searching for something more passive as they retire. So Ben, it's great to see you again. Welcome to the program.
Hey Doug, great seeing you as always. Thanks for having me on.
Yeah, I appreciate you being here. And, I want to kind of start at a broad level. Ben, you have a lot of experience in the industry, certainly with Comfort. And then, of course, your previous experience with BlackRock. You kind of know investment markets as well as anyone. What's your current assessment? It's a real macro question, but what's your current assessment of the real estate investment market in 2025? How's it looking for you guys?
Yeah, I think for us, it's a very specific asset class, but I'll just probably talk about residential as a whole. The residential market is still, from a fundamental standpoint, pretty strong. There's 7 million homes that the U.S. is currently short, so we are definitely still have this supply shortage, and demand for housing, rental housing, is continuing to skyrocket, especially as the mortgage rates and asset prices on homes continues to rise. The affordability aspect of owning a home is kind of becoming more out of reach for millions of Americans who need to then find a place to live. And generally speaking, they're looking to rent. And so from a broad landscape, 30,000 feet in, above, I think that the rental real estate market is still a very strong market. Now, if we talk about what's happening, in the current market dynamics in residential, it's pretty different and it's case by case, and it really has to do with the fact that in apartments, if you want to talk about apartments a little bit, in apartments, you had, during COVID, rent growth go through the roof as people were moving and they're, upgrading, living in maybe a B class apartment to an A class or a C to a B. You had the work from home dynamic. So people are looking for more space, maybe a place where they could set up their laptop and work. And you just saw rental prices go through the roof. At the same time, you had this, interest rates that were basically zero. People were getting 3% interest rates on these multifamily buildings. And then as the Federal Reserve increased interest rates starting in 2021, at the fastest rate that they've ever done in the last 40 years, going from zero all the way up to 5.5. And what that did to the market is it really hurt a lot of real estate owners that were buying at really inflated prices and then taking what's called floating rate or bridge lending to finance those projects. And then they were projecting that this torrid rent growth was going to continue, and that just didn't happen. And then you had this culmination of all these developers bringing on new supply into the market. We have a 40-year high of deliveries into the market. And so if you have all this new supply that comes online, then you have concessions, 1 month free, 2 months free, maybe lower rent as everyone's trying to fight for occupancy. And so you do have some folks that maybe invest with operators and apartment syndicators that are having to issue capital calls because the interest rate on the debt has gone up so much. So that's kind of a long-winded answer to your question, but it was a really broad question, so it's tough for me to answer it without giving me at least 5 minutes.
Sure. No, I get it. And there's a lot in there. I track multifamily, as you know, being a multifamily broker, I track it pretty tightly, certainly for San Diego County. And rent growth, as you're mentioning, is basically flat. It's been 1% probably for the last 12 months, maybe 18 months. I know there has been some transaction volume pickup third quarter, fourth quarter in 2024, and now we'll see if that spills over into 2025. So all that to say is the multifamily market, like I mentioned in the opening, cap rates have compressed a bit. Folks aren't getting the higher returns. Are you looking at that as multifamily is not as solid as an investment it was maybe 36 to 48 months ago, and now on the flip side of that, you have manufactured homes, mobile home parks that aren't having that same type of cap rate compression in 2025?
Yeah, it's a great question then. So I think depending on where you're at in the market, if you own say you've owned it for 20 years, 10 years, you don't have any debt on it, or you have some really accretive low interest rate debt on a multifamily project, you're probably fine. Many of your listeners, your clients, they're probably fine. They're clipping a great coupon and they're doing well. But I think what's a lot of our clients are looking to get out of that active space. They love real estate, they understand it, they like to go see the building, they like the cash flow, they like the tax benefits, and then the overall appreciation, but they're just sick of being landlords, especially in California where you have so much regulatory risk and rent control and legality around it, and if you don't pay rent you can't evict, and then they're seeing repairs and maintenance going up, they see insurance going up, and so they just want out, but they still want to invest in real estate. And so they're coming to us and they're looking to sell out of their apartment assets or their multifamily or their single family rentals and put that capital in with us because they want to do it passively. And what does that mean? We have a team of 50 people. We invest in amazing real estate. I think it's the best real estate you could own. Manufactured housing communities. These are mobile home parks where the tenants actually own the physical homes. We own the communities, so they pay us what's called a space or a lot rent. So we transfer a lot of that risk onto the tenants. To your point on the rents, most of the time we're buying from mom and pop operators that they haven't raised rents in many years and they're far below market rent today. So we're able to capture that rent growth. I call it embedded rent growth, meaning that it's just we're buying deals that are under market and increasing rents over time. And the fact of the matter is the stability of this market. So we have really strong pricing power, meaning that when we increase rents, it's not like someone's going to pick up and move their home because they actually own that home. It's very expensive to move that home. It's roughly between, call it $7,000 and $10,000. And for the most part, the rent that they're paying on that space rent is about 50% of the comparable rent that they'd be paying per square foot to rent a single family home, traditional single family home, or an apartment apartment community, or live in an apartment community. So on average, our tenants stay for about 15 years. So that stickiness of the tenant base provides resiliency. So even during, recessions, manufactured housing communities perform exceptionally well. Been the best performing asset class across all the major food groups in real estate over the last 25 years. And they outperform even in recession. So during the 2008 global financial crisis, net operating income for mobile home parks nationwide actually increased. It didn't go down. And it's because when you go to a recession, the demand for affordability increases.
So, name of the game here is going to be affordability. It sounds like, and when you guys are looking at your investment strategy, even unlike multifamily right now, where the average rent is $2,500 a month in San Diego, even though it's flat, still $2,500 a month is a lot of money for a lot of people to pay for a 2-bedroom apartment. So, what do you guys look for when you're scouting? I know you got a new deal that you guys are promoting right now. One of my clients, I helped get into one of your previous opportunities out there in Texas. What are you guys generally looking for when you're looking for a new park to invest in?
Yeah, we're looking for a manufactured housing community that's around 100 sites. We want to buy larger deals because that provides scale and it brings down expense ratios. When you have, let's just say you have one unit that goes down, on a 100 site park, that's 1% of your rent roll. Versus if you have a 10 site park and you have one go down, that's 10% of your rent roll. So we like to buy in scale. We like to buy in really strong, growing demographics. We're very heavily invested in Phoenix and Dallas. We like areas where you have strong population growth. You have, rent. You have landlord-friendly markets that such as Arizona and Texas, where you're able to operate and you're not your hands aren't tied with things like rent control or the inability to evict tenants that aren't paying you rent. And then we're looking for places where there's a disconnect between what you said, market rents like $2,500 versus where we're renting our communities at. And that way we could provide that workforce affordable housing, but we see that there's tailwinds in order for us to grow the net operating income and the revenue over time. And then we're also looking for you know mobile home parks that are generally have what's called like city services, right? So these aren't parks that are sitting on private wells or private septic tanks. We like city sewer, city water, city gas, city electric, because we don't want to incur those costs if those private utilities go down. And we're also buying in markets where we can create scale because we're vertically integrated and we do everything in house. We have our own property management team. We want to buy a park where we can amass a portfolio of parks close by in that same submarket, both from a business efficiency standpoint as operators, but then also when we go to sell these communities, we are able to put together a portfolio and then roll that up to the large private equity buyers that are looking to buy in scale. So we get some pricing power there when we go to transact and sell these parks if we could provide scale to the market.
Absolutely. Economy of scale certainly would make sense as you're putting those portfolios together. Do you guys have kind of an average timeline that you want to be moving on to a new project, or get your money out of the project and sell it? What is the average?
So we've been doing this for over 15 years, and so if you look at our track record, we generally hold a park for anywhere between 6 to 8 years before we go and sell that park. Every time we sell a park, we always do a 1031 exchange, and we do that because for us as the partners, we don't love paying taxes. We are real estate folks. We love the thought of utilizing a 1031 exchange, selling a property, deferring all the capital gains, and then rolling all of those gains into the upleg of a new property, which compounds your net worth in cash on cash, and then continue to rinse and repeat that model. I would say though that what are some of the challenges in our market is that this is a very sought after asset class, and there's not that many great mobile home parks out there. There's only 40,000 mobile home parks in the entire United States, and that supply every year goes down because some of these parks, they get demolished, kicked out. We're in San Diego. A good example of that is the park that was in the San Diego Bay by Campland. They evicted all those tenants, and then now it's going to be used for something else, whether it's an environmental reason because it's close to the bay, or if they're going to put more high density apartment units there. So the fact that you have this ever-growing demand and the shrinking supply makes for an amazing investment. It's the only real estate asset class that I know that has an increasing demand in terms of residents looking for affordability, looking for this option to own their home, and not share four walls like an apartment complex, and the affordability aspect. But you have a shrinking supply, and it's due to like redevelopments, as well as like not in my backyard or NIMBYism. People aren't generally, City Hall isn't generally a huge proponent of adding new manufactured housing communities to their city. And I could talk a little bit more about that. So it's a really unique supply and demand dynamic. So we're not looking to flip these parks quickly. It takes time to really get a park to where you want to sell it, and you've generated that really strong return where it's ready. But we're always looking, if we're selling a deal, we want to make sure that we're replacing it with something equivalent or better.
Yeah, you mentioned regulatory issues. Certainly in San Diego County, I know there's very few mobile home parks. I know some of the original developers of those, and they've talked about what an incredible challenge it is to operate mobile home parks in San Diego County and anything in California.
Mhm.
We're in a new era. We're in the Trump era. He's calling it the golden age. Do you see any advantages or maybe even disadvantages, regulatory issues that might come down the pipe that might impact you guys in your industry?
Yeah, I think for one is the new HUD secretary that's recently was just inducted. I think that he will provide some tailwinds for the market, and he understands the affordability aspect that we're all facing in the U.S. And so hopefully that provides some tailwinds for us. I think from our standpoint, we like the fact that they're not building more of these just selfishly for our own portfolio, but we would love to see, the fact manufactured housing communities continue to grow because I think it's one of the most sensible solutions to the affordability crisis because we don't have our cars get built in our front driveway. So why do we do that with our homes? We can pull homes directly from a manufacturer. They're done beautifully. You would not know the difference between some of these manufactured homes as well as the difference between a manufactured home and a site built home. And they're done at a fourth of the cost. So generally speaking, we can get a single wide, which is roughly a two bed, two bath, or two bed, one bath, 860 square feet for $60,000 all in. And this has vinyl flooring, quartz countertops. It has all of the aesthetics that of today that the current homeowner is looking for, and we're getting that at like $60 to $70 per square foot. When you compare that to a site built home where you're at, call it 250 to in San Diego County, you're up at $500 per square foot, if not higher. And so that affordability aspect. So that's one piece. The second piece that I touch on is with the Trump administration. What's really topical right now is his tax bill that he's implementing. And so what people don't know about this space, I think they can understand. They drive by a manufactured housing community, they understand what they are. But as an investor, one of the most unique things about this asset class is it's the most advantageous from a tax standpoint, and that's in the form of depreciation. And so when you buy a manufactured housing community, generally speaking, you're able to depreciate that asset on a 15-year depreciation schedule. And with the introduction of Trump's bonus or accelerated depreciation, we're able to upfront most, if not all, of those losses in the year one of our investors' tax bills. So our investors love, especially if you're a real estate investor, you're like, this sounds amazing, right? Because if you invest, let's just say like for simple math, like $100,000, and if the bonus depreciation, which is slated to come back, comes back to 100%, you invest $100,000 and you're getting $100,000 of year one losses on your K1 that you're using to either shelter all of your other rental real estate income. If you sold a property, you could use it in your real estate professional. It's a rental property. You could use that to shelter the gain. And so it's really advantageous for real estate investors to invest in the space, not only for the stability and the overall return and the cash flow, but also for the outsized tax benefits that you get by investing in these communities.
Yeah, I when you and I had that conversation in your office, I think it was last year sometime, that I really keyed in on that because, as you know, when we sell an apartment building, not every owner, or even just a small rental property, duplex, triplex, fourplex, not every owner wants to jump into a 1031 exchange. They
Yeah.
don't want to go straight into that reinvestment. Some of them just want to cash out. They've been in the market for 30 years. They've been managing this property. They just want to take their, chips off the table and enjoy the rest of their life. But they do have a big tax bill if they don't go into any sort of capital gains deferment 1031 exchange. So I really keyed in on the fact that they could take advantage of that immediate depreciation because of the way you explained it, all the personal property that's attached to the infrastructure, and that really made sense for a lot of our clients that are just cashing out. So certainly those tax benefits were key, as well as the returns are good. The idea that folks are getting out of it's almost better that stuff is out of the state of California, because the returns are so much better once you get across
Hmm.
that state line and start going into some of these other markets. And it's a good reason for folks to get out there. And you guys have a long track record. What do you think separates you guys from your competition? You mentioned that it's a very competitive space. I know the team over there at Comfort Capital, you guys have been super successful. What causes you guys to stand out above your competitors?
Yeah, I think a couple of different things. One is that it's our investor base. So we raise money from real people. You know this, Doug, but all of our investors, we have 300 plus investors. These are all word of mouth referrals, people we know. And I think the reason why I bring that up is because to us it's really personal. We're investing in this real estate because this is what we know and we love, and this is the assets that we want to own in our own portfolios and then hand off to our kids one day. And so I think that's first and foremost. We're not, we've had plenty of offers from the big private equity and pension funds that want to come in and back us. And basically that would be our capital source. And then we would have our hands tied. And then we're kind of a forced buyer because we have this money gun to our head to buy these deals that probably don't make sense. But if you have some large pension fund that's like, I need to deploy $100 million of capital, then you're just going to buy deals that maybe don't make sense to you, but they're happy with them. So I think it's really comes down to just our discipline in our investment buying. We're not buying every deal. Last year we looked at 4,000 deals. We underwrote 400 of them. We put LOIs together that made sense on 31 of them, and we closed two of them. So that just kind of goes through our deal sourcing capabilities. So I think that's first and foremost. The second thing is that we're vertically integrated. So we have 55 employees. Comfort Capital is our investment arm. So there's 12 to 14 of us that sit in our corporate office here in San Diego. But then we have 40 plus employees that are actually boots on the ground in the field. These are our property managers, our maintenance folks, our sales staff, our quality control, and we have monthly calls with them. We do Tony Robbins training. It's really a family, and it's really important because people are really, at the end of the day, you're investing in people. And so we have a really strong family oriented team that's invested in driving strong returns for our investors, as well as providing great value and being good stewards to our residents, which is incredibly important as well. And then the last thing that I would say is that um, we really care. Our mission statement, is really providing, a community that anyone would be proud to call home. We are doing amazing renovations to clubhouses. We're innovators. We're doing things that no one else is doing. Just because we want to push the envelope and we want to really change the stigma around living in a manufactured housing community and bring it up to the 21st century and above, and really be innovators in this space, and do it smartly. Like, it doesn't cost a lot of money to open up a lot of these clubhouses that are closed up, and just make them bright and inviting, and places where kids can do homework and they can host parties and update the pool furniture, and doing all of that, and updating playgrounds and all of that stuff, and security protocols, and so forth. So I think really it's just a matter of, like, this is all we do. We don't do any other asset class. We're really focused on this one. And the fact that we've been doing it for 15 plus years for real people that other investors can call and say, hey, how's your experience been with Comfort? And they're real people that say it's been amazing, right? And so I think that's really what differentiates us, is that's family oriented, that operator mindset, and that real focus on driving value, not only for not only for our investors, but also for the residents, which then, it's a full circle. Then it comes back into the value and the returns that our investors, experience.
Yeah, that really, I got the sense of that when we sat down and started looking at some of your guys' project history, and the fact that you're right, man. People don't care how much you know. They like to say until they know how much you care, and you can see that in what you guys do on those projects for the residents. I mean, that's your stewardship, right? So, You're helping clients that are investing, you're stewarding their funds, but you're also delivering good product to the residents, which I saw, which is why we were comfortable sending some clients in your direction. So, Ben, very awesome to hear about all the great things Comfort Capital is doing. What's the outlook for 2025? You guys have, I think, an offering right now, and then what's the expansion plan?
Yeah, so we're in contract for a beautiful institutional asset, 174 units in Dallas. This will be our third asset that we're purchasing in Dallas. And so this deal we're really excited about. We only have a couple $1 million left to raise, so that'll go pretty quickly. But hopefully we do 1 to 2 more deals this year, really focused on the Dallas Fort Worth market, which we really like, as well as Phoenix. And so we own about 12 properties currently in Phoenix. And so looking to grow that portfolio. So we'll see. The deals are tough to get. A lot of sellers, to your point, aren't looking to sell, but we're working really hard. And so hopefully we got probably a couple more deals at the end of the year. But we're excited about the updated tax plan that's coming up with Trump, and just really excited to continue to grow alongside amazing people. So if any of your listeners want to reach out and learn more, I'm always happy to chat with them.
Yeah, absolutely. It's the golden age. What's the best way for folks to contact you if they're interested in reaching Comfort Capital?
Yeah, well, you could reach, we have a website, comfortcapital.com. You can click invest now and they'll prompt an email that goes directly to my team, which I'll get back to you. You could also send me an email at ben@comfortcapital.com, which is pretty straightforward. Or if you know Doug has my number. So reach out to Doug and he can connect us.
Absolutely. We'll put all the contact information in the show notes below. And Ben, thanks for your time, man. It's great talking to you, learning more about what you guys are doing over there this year at Comfort Capital.
Appreciate you, Doug. God bless.
All right. You too, my friend.